Hello, I'm Wesley Barkus, and today we'll be covering PPM, PPO, due diligence, and term sheets. A PPM, or a private placement memorandum, is a document that includes a company's financial statements, managers' profiles, and a business plan. Now, a PPM protects a company from the liabilities that arise when selling unregistered securities. Now, the reason they'll sell these securities is because they need to raise capital, but they don't want to go public like an IPO, so to remain private, they use a PPM and a PPO. The advantages of PPO and PPM are they require much less capital than an initial public offering. Also, it allows you to have more flexibility with what you'd like to do, since it's unregulated like an IPO. Another benefit is they require less time to be put in. They're also attractive to institutional investors, and they allow you to target a more specified investor. Now, a disadvantage is that it requires a large discount rate because it is more risky and it's not nearly as liquidable as a publicly traded stock. Due diligence refers to all of the research conducted on an investment before you invest. Now, this became the norm when the Securities Act of 1933 was passed. There's about 10 steps that you can do to perform due diligence. First, you'll analyze the firm's enterprise value. Following that, you can determine the company's top and bottom line. Analyze financial statements, mostly the income statement, find a profit margin, and the more quarterly reports that you can use, the better look and insight that you'll have. After that, take a look at the industry, see how it's doing, see how healthy it is, and if it'll continue to grow. Next, do evaluation on the company. Once you've done that, you can conduct research on the management team to see if they fit with what you're looking for. Analyze the balance sheet following that to help you evaluate where their liabilities, assets, and cash flow is. Then take a look at the company's history, how they've performed, have they had really bad years, good years, how volatile they are. After that, how many investors are there? That plays a large role in the investment and its volatility and how safe it will be. Next, look at professional analysts and what they've done, and potential growth or shrinkage, and what makes them unique. Following that, perform a total risk evaluation, and after doing all of this, you should have a good idea whether the investment fits for you. A term sheet is a non-binding document that clearly states the terms and conditions of a potential investment opportunity. Now, the contract that is drawn up for this opportunity is based on the term sheet. It often associated with startups. It provides a general overview without going vigorously in depth on the investment, and it's meant to enhance the understanding for both parties to reduce the risk of a miscommunication. It's also used to attract investors. Thank you for your time.